Hello and welcome to the special edition of Bond Vigilantes. I'm joined today by Claudia Calich, fund manager at M&G, and we're here to discuss about emerging markets. Claudia, thanks for being with us today.
You're welcome.
There's been a lot going on in emerging markets so far this year. Everyone was pretty bullish on the emerging markets at the beginning of this year, but then we have seen quite a decent reprice in the market. And particularly when I look at the local currency indices, they are down around 6% this year. So what happened?
Yeah, in my opinion, part of this movement was largely a dollar movement. So if you look at the drivers that caused the dollar to rally, we had a few, including much worse than expected rhetoric by the Trump administration, the fears of the trade wars. So that prompted a bit of a risk reduction by investors. We also had some disappointment within the Eurozone in terms of data. We also had a very short-lived, but a spike in Italian risk premium for a while. Also important to note, investors had been largely underweight the dollar until the beginning of the year, partly because they were adding last year, as at that time the data in the Eurozone was stronger and some of the emerging markets have been much healthier. So this underperformance of the other currencies, in my view, is largely also a dollar short covering move that those investors had to do. But finally, if you look, yes, there was a few key underperformance within emerging market currencies, namely countries like Argentina and Turkey, which those performances were really driven by what's happening, the domestic fundamentals of those economies. But I would say those were pretty much the exception. So my view is still it's much more a dollar story until recently, as opposed to emerging market weakness. If anything, if you look at some emerging market currencies versus a euro, for example, they actually outperformed the euro. So that's another way that I look at the behavior of the currencies.
Okay, so it seems like it was mainly a dollar story. But what about hard currencies? Because spreads widened by around 100 basis points so far this year, and spreads today are around 350 basis points. So what's your take on hard currency?
Yeah, so unlike local currencies where the valuations were fair value, if anything, a little bit cheap in the beginning of the year, the hard currency was a bit different. Hard currency spreads were actually quite tight. So if you look in the first quarter of this year, we had also had a lot of inflows into emerging market bond funds. The valuations were becoming a bit more stretched. So I think this repricing that we've seen in spreads largely reflect the starting point that we were in the beginning of the year, with spreads basically even inside 300 basis points for the sovereigns and also for the corporates. So I think where we are at the moment, as you mentioned, mid 300s is a much more fair value for external debt. This is reflecting much better in terms of risks and rewards to the countries that we're currently investing in.
Okay, thanks. And you mentioned flows below. This is very important, of course, for this asset class. Are you keeping an eye on flows at the moment?
No, emerging market debt has seen outflows for the last 2 months. So this is clearly something that not only myself, but the peers, we're all keeping an eye on. My belief is emerging market flows in or outflows can have a short-term implication on asset prices, whether it is currencies or bonds. But in the long term, what matters is fundamentals and make sure you're doing the homework, picking the right countries, the right companies. So I would say the flows is just, in my opinion, it's a short-term market movement. It is important to remain flexible, to remain liquid. So if you need to raise liquidity, for example, if you're suffering outflows, you have a very well-built, diversified portfolio that can achieve so in this type of environments as well.
Thanks, and that leads me nicely to my final questions in terms of fundamentals. How do you see fundamentals in emerging markets? I mean, it seems like they've been improving a little bit from 2013, but what's your take on fundamentals today in emerging markets?
Yeah, we've seen a big improvement, particularly with the current account deficits that, if you recall, in 2013, we had a lot of countries with very large deficits. So this rebalancing is pretty much complete in most countries, not all of them. There are some exceptions, such as Turkey, but most other countries have actually already rebalanced. Second, now we're starting to see this broad-based growth in starting to improve the fiscal position of many emerging market economies. So we saw a big deterioration earlier on 5 years ago because they were in recession, commodity prices were too low. This is starting to reverse, so the fiscal deficits now are much smaller than what they were a few years ago. And finally, we're still in a position of broad-based growth, which is helping emerging markets to maintain the fiscal position, but also start deleveraging into a few years from now.
Okay, thank you, Claudia. I guess maybe we can say, just in summary, that the growth is still there. Emerging markets, in terms of fundamentals, are not probably perfect, but are still probably fine. And valuations, given the recent reprice in the market, are looking now more attractive. So this might be a better entry point.
No, agreed. I mean, if anything, we have a yield of about 7% for the asset class overall. So I think it's getting more attractive, especially compared to where we were in the beginning of the year.
Okay, thank you, Claudia, and thank you for watching, and look forward to seeing you again.